All right, good evening, everybody. Elliot Katz here from Rich Options Jerk. Want to bring you guys up to speed on what's going on here in the markets. Our newsletter this weekend was entitled Crunch Time for the markets because for anybody that's been paying attention, it's been a really, really rough few weeks. In fact, if we look at the NASDAQ composite, the NASDAQ 100 composite, we are going to see that on a weekly basis, oops, it's not the one, we want the NDX. We'll see that on a weekly basis, last week was the first week in the last 5 weeks that the NASDAQ 100 was actually up for the week. And on a daily basis, any big rallies that we've had, either the one from last week or the one from the week before, have just not been able to be maintained. The market could be a seasonal factor, but I got a sense that it's a little bit more serious than that because I don't think we'd be seeing things like gold going up and the dollar continuing to go down if this was just a seasonal uh, season cause. The cause for this was seasonality. So as I mentioned, if we can get any bearish trades off inside any kind of decent rally back in these stocks, we're going to take it. So today, as I was watching Google, Amazon, a lot of other stocks, the trades just didn't really set up. So we didn't have any new trades today. I'm hoping that tomorrow we'll see some opportunities to do something on the short side. One of the stocks that I'm really watching here, actually there's two. One is Google, which I think is in particularly bad shape right now. And we could look at that here on this platform. If you allow me to just pull this out. There you go. I think you could see pretty clearly that we've put in a possible double top here with no interest in any kind of buying down it to push this thing back up. So this is generally not a good thing when you look at a stock like this. So we're going to be looking for, if there's any kind of rally tomorrow, we're going to be looking for something. If it breaks below here, I think all bets are off, and we could see the stock down to 900 pretty easily. There's a big gap over here down at the 899, 900 area. So it is definitely crunch time. Everybody knows what's been going on with Amazon. Today, Alibaba, which has been a big star, actually faded again for the third day in a row. It's actually just touching its 9-day exponential moving average, but the stochastic is turning down. The MACD is losing momentum, and the DMI is starting to show more negative strength and losing positive strength. And Alibaba, there haven't been a lot of Alibabas in the market lately. It's been one of the few stocks that's been carrying up. So if this thing goes, I think that's going to be that's also going to be an indication that we're going to have some weakness for quite some time. In the other industry groups, the gold stocks had another great day today. This is actually a confirmation. This is a breakout now on these stocks. So any pullbacks here should be used as buying opportunities. So we're going to be looking for some buying opportunities there. The biotechs are a very interesting bunch. Oh, before I get to the biotechs, Again, in the metals, the XME still looking very strong, coming off a very nice bottom here, testing this breakout here. You've got stocks like Freeport McMoran and other stocks in that group behaving very well. Newmont Mining is in that ETF. So you take a look at Newmont Mining on a breakout, Freeport. I really would like to be able to do something on these on a pullback. We did miss this little pullback here, but if we look for another little dip here, it'd be a great place to go long. I think this bottom that the stock made between May and July is actually going to be pretty significant. And with the dollar going down, and if the strength in the overseas economies continues, I don't see any reason why this couldn't keep moving to the upside. Okay, now back to the biotechs. The biotechs have been a very, very interesting group here. Just when they start looking bad, they start looking good again. So we're going to have to keep our eyes on these. You look at a stock like Amgen. Yeah, it's coming off a bottom here, but there was some damage done here. Same thing with Celgene, was looking great, and then it broke down, and now it's starting to get a little bit of momentum back to the upside. Okay? I think the couple of stocks that have really kind of helped this index get back up have been Gilead and Biogen, have really been the two stocks that have really helped the IBB get back in gear. So we may be seeing a nice consolidation here, but there are a lot of stocks in here that are not in the best shape. So we're going to have to keep our eyes on those as well. Okay. I was looking at Alexion today as a possible trade. That stock right here has a really nice chart. It's consolidating nicely here after coming off of this bottom, but the earnings just passed the earnings are not until October 26th, so we do have a good couple of months here to play this before we have to worry about event risk. So Alexion came up today. For those of you who are joining a little bit late, I was just saying that as far as looking for opportunities, stock like Google, if it does not start getting going here, this could be a real problem here. You don't see these double tops. If you don't see stocks recover from these double tops very, very well if there's no buying power coming in when you get back down to that bottom right there. So been looking for some opportunities there, but because I guess I'm a little cheap, I've missed a couple of trades there. So we'll see if we can get another rally in there. Maybe in the next day or two, maybe we'll find a nice shorting opportunity there in Google. And as I said on the Alibaba, if this having been one of the great stars in the market, if this is starting to show some weakness, you could see the stochastic is kind of rolling over and the MACD is losing some momentum here. This could just be another one in the mega cap spaces to lose its positive momentum. So I think this week we're kind of in a holiday environment. So a lot of strange things can happen. I'm not really going to force anything in terms of trades right now. But if something does come up, I will definitely talk about it. Uh, so with that said, let me bring you up to speed on something that we've been doing in this JP Morgan. In the course, we talk about these diagonal spreads, and part of the game of the diagonal spread is to bring in if the trade is not working out right away, because if you've been following along in the last few weeks, we had some diagonal spreads that we actually took off very quickly. One was in Pepsi, where we put the trade on August 8th, even though we were the long part of the Pepsi was the September 22nd 115 call, and we were short the August 18 118 call, okay, which is a $3 wide diagonal call spread, which is with a bullish bias, right? Because we're long the lower strike and we're short the higher strike. We actually took that trade off on August 17th. So it was only nine days. But the stock had moved up, and the point was that there was an attractive enough profit in that trade to not have to worry about collecting premium week after week after week to try to limit the risk, lower the cost of the trade. So this JP Morgan trade right here, where we're long the September 90 call and we're short their September 92.5 call right now. Right now, if you just looked at this cost of this September 90 call, which we purchased on July 25th, that's about a month ago, we paid $4.15 for it. So you look at this and you go, holy cow, this thing's only trading at $2.23. What the heck's that all about? Right? That's looks like a total mess. Okay, well, it's not really a total mess because this September 1st, the one that expires this Friday, with a 92.5 call, we actually collected 52 cents for that. Now, that's not the only option that we've sold in the life of this trade. When this trade started on July 25th, we actually sold a strike of 93 call for the week. The first week that we put the trade on July 25th, we actually sold the 93 call that had expired, that was going to expire that Friday for 58 cents. So what's happened is, as the stock has moved around, and right now the stock's 91.60, it's actually way off the intermediate highs that it had, which was above 93. The cost of this trade right now is down to $2.21. So even though the stock has backed off tremendously and the long call is down $1.90, from the point of view of the overall trade itself, that trade right now is only down around 20 cents. 223 for the option that we own and 21 cents for the option that we're short, with another 2 weeks to go because we have 2 more chances to collect premium. So what we're doing when we do these diagonal spreads, which is something that we tend to really like here, is we like the idea of having multiple opportunities to try to manage a trade as the stock moves through time, right? Sure, we're gonna talk about vertical spreads, vertical debit spreads, spreads you pay for, vertical credit spreads, spreads that you get paid for up front. But you're going to see a lot of things going on here. You always see a lot of things happening in the diagonal spreads. Okay, and another diagonal spread that we actually have on right now is in Verizon. Okay, it's actually a bullish, has a bullish bias. Okay, and you could, this one we have not done any follow-up trades yet because the call that we sold doesn't expire until September 15th. Okay, so we sold that, we sold that call for 48 cents. It's trading at 42. So we're making about 6 cents there. And the option that we bought, which is the December call for 232, that's trading at 244. So that trade, which we put on August 16th, it's winding its way up to, we're up about 19 cents on that trade right now. Remember, the diagonal trade is designed to be a singles and doubles type of trade. It's not a hit the ball out of the ballpark kind of trade. Okay? If when we think we're going to see opportunities to do that, we might throw it in here every once in a while, but that's not the point of the course. It's not the point of the way that these trades that we're using to show the concepts in the course are really designed. Those kind of trades, those purely directional trades, don't really capture the real essence of what the course is all about. So we've got this Verizon trade on, we've got the JP Morgan trade on, and what I wanted to talk about today from a position management point of view is this trade in AbbVie. Okay, this is actually a bearish trade. We're long the November 70 put, and we're short the September 67.5 put. The stock, when we did this trade on August 16th, the stock was clearly lower than it is today. The stock's actually been going up. Okay, now we're still bearish on the stock. This rally could be in response to what's going on in the market right now. AbbVie is a biotech company. It's a drug company, and I think it was a spinoff from Abbott Labs. And I think, in a way, perhaps because of the conditions that we're seeing in the marketplace, this could be healthcare could be seen as somewhat of a refuge, at least in the short run. Okay, so we have until November for this trade to work out. We can manage this trade through November. Now, will it become a profitable trade? I don't know. But right now, if we took it off, we would have a loss of 87 cents in this trade, which in the grand scheme of things is really not a terrible thing. We're starting to compile the results of these educational, we like to call them educational trades that we've been using in the course, and the results so far have been really good. We've had a very high percentage of winners, and we've been making 80 cents, a dollar, 90 cents, 70 cents on a lot of the trades. So if this trade happens to be one where we lose 87 cents and we have, an 80+% success rate, then that's just the way it is. But what I'm getting at is the fact that as long as we still have opportunities between now and November to manage this trade, well, why don't we try to lower the risk of the trade so that if something does happen between now and November, we're limiting the overall risk of the trade, and we still have some opportunities to turn it back into chicken salad, as I like to say, if the stock starts behaving favorably for us, which is going back down. So I wanted to talk about this because I actually mentioned this in the newsletter. Uh, for those of you who have been picking up the newsletter and have had some experience with spreads, okay, what you want to know is the following. What you have to be aware of is the following. Regardless of the expirations, if you're long a higher strike put than the one you're short, that has a bearish bias, right? Because you're long a high strike put. In other words, you have the right to sell the stock at a higher price at which someone has the right to sell it to you. Okay. So if these two options had the same expiration, it would look like a bearish put spread, right? We'd be long the November 90 put and we'd be short the September 67.5 put. Okay. This just so happens to be a put diagonal spread, but it's the same basic idea. But as you know, the reason we split up the expirations because we like to have those multiple opportunities to manage the trade and possibly collect premium, additional premium along the way. Now, it also follows then that if the strike price that you have sold, the put strike that you have sold is a higher strike price than the put that you have purchased, then that has a bullish bias. In other words, if I were short the November 70 put and long the November 67.5 put, that would actually be a bullish trade. Why? Because being short the 70 put means that someone has the right to sell stock to me at 70, but I only have the right to sell it at 67.5. So that's a $2.50 spread that could work against me if the stock were to go down. Okay, the stock going up actually is good for me. So it's the reverse. Okay, so what I said in the newsletter is that if we're looking at some of these stocks like Google or what was the other one? Alibaba or some of these biotechs or whatever. If we're looking at bearishly biased trades using put diagonals where we're long the longer term higher strike put and short the shorter term lower strike put, if the stock starts moving up, we can actually change the shape of the spread. Even though it's still a diagonal spread, a time spread, we can evolve the trade from something that has a bearish bias to something that has a more bullish bias or a neutral bias. And the way we do that is by moving the short strike from being below the strike price of the option we own to being above the strike price of the option we own. Okay, and what does that look like? So what I did, I didn't do the trade, but what I did for the purposes of the webinar today is I actually put together an example of this using AbbVie, using our AbbVie trade right here. Okay, where you could see we're long the November 70 put and we're short the September 67.5 put. If we just look at the risk profile of that trade, you could see with the stock up here at around 73 right now, the trade obviously has a bearish bias, right? There's the 67.5 price. The pink line happens to be today, and the blue line happens to be the September 15th expiration. So the important thing to remember when you look at this is that the bump where the maximum profit is, number one, it's at the strike price of the short option, and it is below the strike price of the option we own. Okay, so There's a trade right now that if we didn't do anything on September 15th, we would expect to get the results of that blue line. Meaning our maximum risk would be way, if the stock was way up here, somewhere around 220 bucks, which we would prefer not to have happen. And our maximum profit up here would be about 160 bucks if the stock closed exactly at 67 and a half, because at 67 and a half, the September put expires worthless, and we of course have at least $2.50 of value plus extrinsic value in our 70 put. Okay, and as you can see, we only spent $226 for that trade. Okay, so that's where we're starting. So just remember that the bump is the peak of the mountain, if you will, right now is at 67 and a half, and that is below the strike price of the option we own, right? So now what we're going to do is we're going to change that up. What we're going to do is we're going to shift that trade, at least for the next week or two. We're going to shift that from having a bearish bias to having a slightly bullish bias. Why? Because by moving the put strike up from 67 and a half to some strike above 70, we should be able to collect additional premium and then take a look at what the new trade looks like. Okay, what the new profit loss looks like. Okay, so let's do that. I'm going to show you all of the strike prices because I want to go down to the September option that we're short, which is right here. You see right now it's only worth 7 cents. We sold it for 37 cents. So we're going to buy that guy right there. You can see there it is. Let me adjust that to a 1 lot. You know what? I shouldn't do that yet. There you go. So let me leave that at a 5 lot. Let's close this guy down. Let's close that guy down, and let's see what we can get. I know it's already Monday, but let's see what we can get for selling. Where's the stock right now? 73.32. Let's see what we can get for the 72 and a half put for the rest of the week. Okay, so that's 13 cents. So net, we're not going to collect very much extra premium. And one of the reasons is that the volatility has really come out of this stock. And that generally happens when the stock goes up, volatility goes down. So the implied volatility goes. So let's push it out. Let's push it out to next Friday, September 8th, and let's sell the 72 and a half put. Okay, which is 80 cents below the current price. Now, obviously, if we're selling that put and the stock starts going back down, we're going to have to be on our guard and start following the stock back down again, right, by rolling that put to lower and lower strike prices. But for now, let's see what happens if we move the strike price of the short option from being below the current stock price to being above the current stock price. Well, what's the first thing that happens? We collect about 30 cents. So now, instead of having a trade that cost us $2.26, we now have our risk, and I'm using air quotes here, our current risk is actually a little bit below $2. Okay, so that's $2 of risk if the stock just runs completely away from us, okay, without us doing anything. Now, what is that going to look like on September 8th? Well, we do that by looking at the risk profile. Okay, and here's the new risk profile. Where is the new bump? The new bump is at 72 and a half. See, the old bump was at 67 and a half, which is over here, which is now a place where we will have a loss. Why? Because now we're short a 72 and a half put which at 67.5 is now $5 in the money. And the put we own, which is the 70 put, well, that's only $2.50 in the money. See, so what we've done is we've reversed the way the trade looks, right? It now looks much more bullish, right? Because now the bump is on the right-hand side of the option that we own, the put that we own, versus being on the left side at lower prices, okay? So this is a potential management technique in the diagonal spread trade. Hey, now we go over here and we look at next Friday and we go, well, looking over here at 72.5, it says that we're still losing $50. Okay? Well, you might say, well, why would I do that? I'm locking in a loss. Okay? The point is that we're probably not going to take the trade off on that day. Remember, we still have until November, which means we can continue potentially to collect premium. So let's just throw something out there, right? It's a fantasy, right? We're just throwing something out there. Let's say the stock gets to 72.5, okay? And we have until okay? And we have until November, okay? So I don't even know. That's going to be, let's say, 8, 9 or so weeks from September 8th. So let's say the stock's at 72.5 and it just stays at 72.5. And for the next 8 or 9 weeks, we can collect enough premium to get that risk down to almost zero, right? So if we can get that risk down to almost zero, that would mean our net cost is almost zero, okay? So if our net cost is going to be almost zero, what do you think this thing's going to look like? It's going to have a similar shape, but all of this entire graph is going to be way up here, starting at the zero line, where now we have a loss of whatever this is. It says $400, right? It'll have, well, actually be, what would it actually be if we kept 7 and 7, $250 here would be the maximum loss, right? Because we'd have the cost down to zero. We'd be short a $2.50 spread. But this distance right here between 400 and 50, that's $350, right? So this actually ends up to be a very nice profit, over $100, because this entire blue line is going to be pushed up above this. This is going to go up by the amount of extra premium that we've collected over the time period. Okay, so this technique, if we just make a little movie here, here's where we're starting, right there, and there's where we are now. Okay, the bottom scale is not changing. See, 73 is still here. I haven't changed this. The program has not changed this scale right here, but it has changed the way this looks, right? Because right now at 7, if the stock stays at 72.5, and we did want to take the trade off on Friday, that's $114 loss. I mean, that is a I'm sorry, that's not. That's September 16th. On September 16th, it would be $114 loss. And if we move the trade this way, if the stock is 72.5 on September 9th, it's only a $48 loss. Okay? So we just changed the whole dynamic of the trade over the next two weeks. We've changed it from something that's going to lose us about $100 if the stock stays at 72.5, to something that might only lose us about only about $50, right? With the additional opportunities to sell more premium. And that to us is the name of the game. What we always say uh, here is that stocks move. We know that for sure, but we also know that they move through time. And what other security allows you to trade stocks through time, managing stock movement and time at the same time? There's nothing else out there that lets you do that. Is it going to be perfect every time? No, it's not going to be perfect every time. Okay? And if you want to swing for the fences, right, and try to guess which way things are going all the time, then there's a different kind of trading for that. But this kind of trading is trading that we believe is much more strategic, much more thoughtful, much more flexible, and continues to give you as many at bats to try to make money and make money consistently. Okay, so that's what I want to mention today. I'm going to be back on Wednesday at the same time. Uh, if there's anybody out there, if you got any questions, you could type them in the box. I believe there's a box there, and you could type some questions if you have any questions. I'll wait a minute or two to see if there's any questions that come up. All right, then. Well, with that, I'll wish everyone a very successful next couple of days in the markets, and we'll give you an update on Wednesday. So, everybody, take care and good.